Hello, and welcome to Boni's Life, the channel where we make sense of the complex world of finance and economics. Today, we're tackling a behemoth of a topic, one that affects every single one of us. From the price of our morning coffee to the value of our life savings, the state of the global economy in late 2025. Now, I know what you might be thinking. The global economy? Boni? Isn't that a bit dry? And you wouldn't be entirely wrong. The headlines are a dizzying mix of jargon and acronyms. GDP, CPI, quantitative easing, stagflation. It's enough to make anyone's eyes glaze over. But what if I told you that behind these terms is a dramatic story? A story of power, politics, and monumental shifts that are reshaping our world in real time. A story with a cast of characters that includes Wall Street titans, central banking maestros, and political leaders making trillion-dollar bets. In this episode, we're going to cut through the noise. We'll dissect the latest data from the world's leading financial institutions like the International Monetary Fund and the OECD. We'll unpack the big trends, from the stubborn ghost of inflation to the new walls of protectionism going up around the world. And most importantly, we'll hear directly from the financial world's heavyweights. We're talking about legendary investors like Dalio, banking chiefs like Dimon, and influential economists who are reading the tea leaves and telling us what they see coming. My goal today is simple: to equip you with a clear, accurate, and intellectually honest understanding of where we stand. We'll navigate the complexities with a bit of clarity and, yes, even a touch of humor, because let's face it, when you're talking about trillions of dollars, sometimes you have to laugh to keep from crying. So whether you're a seasoned trader or just someone curious about the forces shaping your future, stick around. This is the ultimate guide to the global economy right now. Let's get into it. All right, let's start with the big picture. When you want to take the temperature of the global economy, the first place you look is the International Monetary Fund, or the IMF. Twice a year, they release their World Economic Outlook, and it's essentially the closest thing we have to a global economic report card. The latest one, from just this October 2025, paints a picture that is, well, let's call it complex. The headline number is global growth. The IMF projects the world economy will grow by 3.2% in 2025. Now, on the surface, 3.2% doesn't sound too bad, right? It's growth, after all, but context is everything. This is a slowdown from 3.3% in 2024, and they expect it to dip further to 3.1% in 2026. To put that in perspective, the historical average is closer to 3.8%. So, we're in the slow lane, and it seems we might be here for a while. It's a bit like you're running a marathon, and you are hoping to pick up the pace, but instead, you're being told to expect a slight persistent headwind for the next couple of kilometers. You're still moving forward, but it feels like a slog. The story gets more interesting when you look at the breakdown. The IMF splits the world into two camps. The advanced economies, think the US, Europe, Japan, and the emerging market and developing economies, countries like China, India, and Brazil. The advanced economies are growing at a sluggish 1.5%. That's barely keeping the lights on. Meanwhile, the emerging markets are doing the heavy lifting, growing at just over 4%. This divergence is a major theme. It's a multi-speed world, and the traditional economic powerhouses are the ones stuck in first gear. So, what's putting the brakes on global growth? The IMF points to a few key culprits. First, the aftershocks of the aggressive interest rate hikes we saw over the past few years are still rippling through the system. Central banks raised rates to fight off that nasty bout of inflation, and that medicine, while necessary, has side effects. Namely, it makes borrowing more expensive for businesses and consumers, which tends to slow down economic activity. Second, and this is a big one, is the rise of what the IMF politely calls geo-economic fragmentation. What they mean is protectionism, trade wars, tariffs. In April 2025, the US announced sweeping tariffs, sending a shockwave through global supply chains. While the worst-case scenarios were avoided thanks to some last-minute deals and exemptions, the damage was done. The open, interconnected global economy we've known for decades is changing. Walls are going up. The IMF warns that this uncertainty and the constant threat of new tariffs are acting as a wet blanket on global trade and investment. And finally, there's inflation. The good news is that it's coming down globally. The bad news It's not going down in a straight line, and in some places it's proving stubbornly sticky. The US, in particular, is still struggling with inflation that's running above the Federal Reserve's target. This keeps the pressure on central banks and adds another layer of uncertainty to the outlook. So the IMF's report card for the global economy reads something like this. Shows resilience, but progress is slow and outlook is fragile, easily distracted by trade disputes and prone to bouts of inflation. Must try harder to foster cooperation. It's a cautious, even downbeat assessment. But the IMF is just one voice in this global choir. To really understand the risks, we need to dig deeper into the specific challenges that have some of the world's smartest financial minds losing sleep at night. And that's exactly where we're going next. Now, if the IMF report is the official diagnosis, think of what we're about to discuss as the specialist's second opinion. We're going to turn to the titans of the financial industry, the people who aren't just analyzing the economy, but are actively navigating it with billions, sometimes trillions, of dollars on the line. And when they speak, everyone from Wall Street to Washington listens. First up, Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates. Dalio is known for his deep, almost philosophical takes on economic cycles, and his latest warnings are impossible to ignore. He sees not one, but 5 major forces shaping our world, and frankly, most of them are flashing red. Dalio's 5 forces are the debt and money cycle, internal political disorder, the breakdown of the world order, climate change, and finally, technology. He argues the first 4 are all worsening, but the one he's sounding the loudest alarm on right now is debt, specifically US government debt. In a recent interview, he laid out the numbers in stark terms. The US government is spending $7 trillion a year but only taking in $5 trillion. He says, and I quote, "It's spending 40% more than it's taking in." Think about that for your own household budget. It's simply not sustainable. The US national debt has ballooned to a staggering $38 trillion. Dalio's crucial point is that for decades, the US could borrow whatever it needed because US government bonds were seen as the safest asset in the world. But that's changing. He warns that the world is becoming saturated with US debt and is losing its appetite to buy more. The result? As he puts it, we're approaching a point where that's no longer true. This isn't just an economic problem. Dalio calls it a political problem. Politicians, he argues, are trapped between 2 promises they feel they have to make. I will not raise your taxes, and I will not cut your benefits. You can't do both when you're already this deep in the red. It's a collision course. And Dalio believes we are heading for a crisis. Now let's switch from the hedge fund philosopher to the ultimate banking insider, Jamie Dimon, the CEO of JP Morgan Chase, the largest bank in the United States. If Dalio is the strategist looking at the world from 30,000 feet, Dimon is the general on the ground, seeing the battle up close. And his message is one of extreme caution. While the US economy has shown surprising resilience, with GDP growing at a healthy 3.8% in the second quarter of 2025, Dimon isn't popping the champagne. He is looking at the horizon and seeing storm clouds. He recently said that a US recession could still hit in 2026. He's not saying it's a certainty, but he's not ruling it out, which is a big deal when many on Wall Street were starting to believe we were in the clear. Dimon's view is that we're in a bit of a strange paradox. The economy is being propped up by some positive forces, like deregulation and stimulus spending, but he also sees major risks simmering beneath the surface. He's worried about the same things as the IMF, the delayed impact of tariffs, geopolitical instability, and the big question mark over whether the massive investments in artificial intelligence will actually pay off. Dimon is particularly concerned about a potential stock market correction. In an interview just a couple of weeks ago, he said he was, quote, far more worried than others about this risk over the next 6 months to 2 years. It's a classic Jamie Dimon statement, pragmatic, a little bit ominous, and a clear warning not to get complacent. He runs his bank by preparing for the worst, and his message to the market is that it should be doing the same. So you have Ray Dalio warning of a looming debt crisis, and Jamie Dimon telling us to brace for a potential recession and market correction. These aren't fringe alarmists. These are 2 of the most powerful and respected figures in global finance. Their shared caution tells us that despite some positive headlines, the foundations of the global economy are shakier than they appear. But what about the other major institutions? What does the rest of the world think? Let's take a look at the view from the OECD. If the IMF is the world's financial doctor and the big bank CEOs are the specialists, then the Organization for Economic Cooperation and Development, the OECD, is like the seasoned public health expert. They represent a club of mostly rich developed countries, and their analysis provides a crucial perspective on the long-term health of the global economy. And their latest checkup from September and October 2025 serves as a stark reality check, especially for the United States. The OECD actually upgraded its forecast for global growth in 2025 to 3.2%, which sounds like good news. They noted the surprising resilience we saw in the first half of the year, driven by strong performance in emerging markets like Brazil and India, a gusher of AI-related investment in the US, and heavy government spending in China. But, and this is a very big but, they see this as a temporary sugar rush. The real story is what comes next. For the US, the OECD's forecast is a flashing yellow light about to turn red. They project US growth to slow sharply from 2.8% in 2024 down to just 1.8% in 2025, and then slide further to a mere 1.5% in 2026-2026. Let me be clear, 1.5% growth is economic stagnation. It's a pace at which it would take more than 3 decades for the economy to double in size. For the average person, that means slower wage growth, fewer job opportunities, and a tougher path to achieving financial security. It's the silent thief of the American dream. So, what's behind this gloomy forecast? The OECD points a big fat finger directly at the new wave of protectionism. They warn that the, quote, full effect of tariff increases have yet to be felt. By August 2025, the effective US tariff rate had jumped to 19.5%, a level not seen since the 1930s. The OECD argues that while companies have been absorbing some of these costs so far, it's only a matter of time before they are passed on to consumers in the form of higher prices. This is a direct tax on households and businesses, and it's a major drag on growth. One analyst writing about the OECD report put it perfectly. This level of trade restriction is not just a policy tweak. It is a historic reversal of America's pro-growth, pro-trade legacy. But it's not just about tariffs. The OECD also expresses concern about what they politely call weak productivity growth. This is a coded way of saying that governments, particularly the US government, are getting in their own way. They point to 2 major issues. First, runaway government spending. Federal spending in the US has exploded, crowding out private investment that is essential for innovation and long-term growth. Second, the mountain of regulations. The OECD suggests that the sheer volume of red tape, from energy project delays to healthcare mandates, is making it harder and more expensive for entrepreneurs to start businesses, expand, and create jobs. They also cast a skeptical eye on industrial policy like the CHIPS Act, warning that while it might sound good to throw billions at strategic industries, it often leads to cronyism and distorts the market, ultimately squandering resources rather than creating real prosperity. The OECD's message is a powerful and sobering one. The recent economic resilience might be a mirage, a short-term boost from temporary factors that masks a much more worrying long-term trend of slower growth driven by poor policy choices. Their report is a plea for a course correction, less government spending, smarter regulation, and a return to freer trade. The question is, are the policymakers listening? That brings us to the central bankers, the people in the eye of the economic storm. In any discussion about the global economy, all roads eventually lead to the central banks. These are the institutions like the US Federal Reserve and the European Central Bank that wield the powerful tools of monetary policy. They set interest rates, manage the money supply, and are tasked with the delicate balancing act of keeping inflation in check while promoting economic growth. Right now, they are facing one of the most complex dilemmas in recent memory. Let's start in the United States with the Federal Reserve, or the Fed, and its chairman, Jerome Powell. For the past couple of years, the Fed has been on a crusade against inflation, raising interest rates at the fastest pace in decades. This aggressive action has worked to some extent. Inflation has cooled from its peak. But now, Powell is walking a tightrope. The labor market is starting to show signs of weakening, and the full economic impact of those tariffs we talked about is still a major unknown. The central bank is caught between a rock and a hard place. In his recent speeches, Powell has acknowledged this shift. He has noted that the Fed's focus is moving from being solely about inflation risks to also considering employment concerns. The big question for the Fed is, have they done enough? If they cut interest rates too soon to try and boost a slowing economy, they risk letting inflation flare up again. If they wait too long, they could push the economy into a full-blown recession. It's a high-stakes guessing game, and the Fed is having to make its decisions without all the data it needs, partly due to disruptions from the recent government shutdown. This situation has led to some sharp criticism. One former chief of the Bureau of Labor Statistics even warned that Powell is flying blind at a pivotal moment. The market is currently betting on the Fed to continue cutting rates, but the path forward is anything but certain. As Governor Christopher Waller, a key voice at the Fed, noted, while the effects of tariffs on inflation might fade, the Fed's core mission is to target 2% inflation over the long run, and they're not there yet. Now, let's cross the Atlantic to the European Central Bank, or the ECB, led by its president, Christine Lagarde. The situation in the Eurozone is different, but no less challenging. While the US is grappling with stubbornly high growth and inflation, Europe is facing economic stagnation. The ECB's own projections see the Eurozone economy growing by a paltry 0.9% in 2025. That's a snail's pace. Lagarde and the ECB have a different problem. They've also been fighting inflation, but their bigger fear is a prolonged economic slump. The war in Ukraine, energy price shocks, and weaker global demand have all hit the European economy hard. As a result, the ECB has already started cutting interest rates, but they are proceeding with extreme caution. The consensus is that they will likely pause their rate cuts for a while, keeping rates steady as they wait to see how the economy evolves. Lagarde has also been a vocal critic of the rise in global protectionism. She recently warned that the global economy has yet to feel the pain from the new wave of tariffs and that it's only a question of time before the full impact is felt. This highlights the interconnectedness of the global system. Even if the ECB gets its policy right for Europe, it can't insulate the continent from a global trade war. Her message is clear. Central banks cannot solve problems created by politicians. They can react, they can try to mitigate the damage, but they can't fix a fragmented world. So what we have are the world's two most powerful central banks facing different but equally perilous challenges. The Fed is trying to land a plane in a storm without clear visibility, while the ECB is trying to restart a stalled engine while the road ahead is being torn up. Their actions over the next few months will be critical, but their predicament underscores a larger theme: the limits of monetary policy in a world beset by political and structural problems. They can't print their way out of a debt crisis, and they can't cut interest rates to solve a trade war. This brings us to our final analysis. What does this all mean for you? And what is the ultimate takeaway from the state of the global economy in late 2025? So, where does that leave us? We've taken a whirlwind tour of the global economy. We've looked at the IMF's cautious report card. We've heard the stark warnings from financial titans like Ray Dalio and Jamie Dimon. We've absorbed the OECD's reality check on long-term growth. And we've peeked behind the curtain at the unenviable dilemma facing the world's central bankers. It's a lot to take in. The picture that emerges is complex, fragmented, and fraught with risk. But it is not without clarity. In fact, I believe four major themes have emerged that define the new economic reality we are all living in. First, and most importantly, we are witnessing the end of an era. For the past 30 years, we lived through a period of what economists call hyperglobalization. Trade barriers fell, capital flowed freely across borders, and goods were made wherever it was cheapest, creating complex globe-spanning supply chains. This era delivered incredible efficiency and cheaper goods, but it was built on a foundation of relatively stable geopolitics. That foundation has cracked. What we are seeing now with the rise of protectionism, the strategic competition between nations, and the weaponization of economic policy through tariffs and sanctions is the dawn of a new, more fragmented age. This isn't a temporary blip, it's a structural shift. The IMF, the OECD, and voices like Christine Lagarde are all telling us the same thing. the world is being rewired. This new reality will be less efficient, likely more inflationary, and certainly more volatile. The assumption that goods, capital, and ideas will always flow freely is no longer a given. This is the new normal, and it changes all the rules. Second, the biggest risks to the economy are no longer purely economic. They are political. This was Ray Dalio's most powerful point, and it echoed through every piece of analysis we've looked at. The $38 trillion US debt, that's a product of political choices and promises. The tariffs that are choking global trade, a political decision. The pressure on the independence of central banks, purely political. The risk of social unrest in countries with high youth unemployment, a direct consequence of political and economic failure. For decades, economic analysis could often be done in a vacuum, focusing on models and data. Today, that's impossible. You cannot understand the economic outlook without understanding the political landscape, the internal divisions within countries, the populist backlash against globalization, and the escalating competition between great powers are now the primary drivers of economic risk. It means that economic forecasting has become exponentially more difficult. It's no longer just about predicting consumer behavior. It's about predicting election outcomes and geopolitical chess moves. Third, we are living in a world of the great divergence. The IMF's data showed this clearly. The traditional economic powerhouses, the advanced economies, are struggling to generate growth, stuck at a sluggish 1.5%. Meanwhile, the emerging markets are the ones with the dynamism, growing at over 4%. This isn't just a statistical curiosity. It represents a fundamental shift in the balance of global economic power. For a long time, the narrative was that emerging markets were catching up. Now, in many ways, they are the ones setting the pace. This has profound implications. It means the centers of global consumption, investment, and innovation are shifting. It also creates a more complex multipolar world where a single country's policies have less sway. While the US economy remains the most important, its ability to single-handedly dictate the global economic weather is diminishing. This divergence brings opportunity for investors who can spot the new growth engines, but it also adds to the geopolitical friction as the old guard adjusts to a new world order. And fourth, there is the ultimate wildcard, artificial intelligence. Throughout our analysis, AI has been the ghost in the machine. It's the source of optimism for some, like the analysts at Goldman Sachs, who see it driving a new productivity boom, potentially lifting US growth for the rest of the decade. It's the reason for the frothy-looking tech stock valuations that have people like Mohamed El-Erian talking about a rational bubble. But it's also a source of immense risk. Both Jamie Dimon and the IMF have warned that if the lofty profit expectations for AI fail to materialize, the market could reprice sharply, triggering a financial shock. It's the dot-com boom of the late 90s on steroids. The potential upside is enormous, a genuine revolution in productivity that could lift living standards for everyone. But the path there is likely to be a classic bubble and bust cycle, creating massive volatility along the way. AI is the one force that could potentially allow us to break out of the low-growth trap the OECD described. But it could also be the catalyst for the very market correction that Jamie Dimon is worried about. It is, without a doubt, the most important and least predictable variable in the long-term economic equation. So, that's the new reality. A fragmented, political, divergent, and technologically uncertain world. The big question is, what does this all mean for you? How do you navigate this? Well, let's start with what you probably shouldn't do. You probably shouldn't panic, stuff your life savings under the mattress, and start a chicken farm in your backyard. Although with the price of eggs, maybe that's not the worst idea I've ever heard. Jokes aside, this new environment demands a new mindset. For investors, the game has changed. The era of simply buying the index, relying on a perpetually rising tide, and ignoring geopolitics is over. The increased volatility and divergence mean that risk management is paramount. Diversification is no longer just about stocks and bonds. It's about diversifying across geographies and asset classes. Understanding the political risks in different countries is now just as important as reading a company's balance sheet. And as Ray Dalio noted, In a world of massive government debt and currency debasement, alternative stores of value, like gold, may play an increasingly important role in a portfolio. For savers and homeowners, the environment is tougher. Stagnant growth in advanced economies means that wage increases may be harder to come by. And while inflation is falling, it may settle at a level higher than the 2% we were used to. This means the silent erosion of your savings is a real and present danger. It makes financial literacy and having a clear, long-term financial plan more critical than ever before. Ultimately, the single biggest takeaway from the state of the global economy in late 2025 is this: you need to pay attention. The world is more complex and moving faster than ever. The forces we've discussed today, from the decisions made at the Federal Reserve to the trade policies enacted in Washington and Beijing, have a direct and tangible impact on your life. Understanding them is not an academic exercise. It is an act of financial self-defense. Our journey today was about cutting through the noise and connecting the dots. We've seen that while the global economy is not on the brink of collapse, it is navigating a minefield of significant and interconnected risks. The path forward is narrow and uncertain, but it is not hopeless. There are still incredible opportunities in the pockets of dynamism around the world and in the transformative potential of new technologies. Navigating this new world requires a clear-eyed view of the risks, a healthy dose of skepticism for simplistic narratives, and an unwavering commitment to educating yourself. And that is exactly what we will continue to do here at Boni's Life. Thank you for joining me on this deep dive. I hope you found it as enlightening as I did. What are your biggest concerns about the global economy? Do you see opportunity or peril in the rise of AI? Let me know your thoughts in the comments below. I read every single one. And if you want to keep making sense of this complex world with us, make sure you subscribe and hit that notification bell. Until next time, stay curious, stay informed, and take care of your financial life.